People usually look to the stock market or real estate when they want to multiply their capital. But while those markets sleep, a massive, invisible network of data is moving capital around the clock, 24 hours a day, 5 days a week. This is the foreign exchange market, or Forex. Every single day, over $7 trillion surges through this system. That is more volume in a single day than the stock market, the crypto market, and real estate combined. Instead of buying shares in a company, you are trading one nation's economy against another. You are watching a continuous tug-of-war between two currencies, like the euro and the US dollar. When one gains strength, the other loses ground. Even with that astronomical volume, the actual value of these currencies barely changes from day to day. A typical daily shift is microscopic, often moving less than 1 or 2%. This presents a significant challenge. If the daily shifts are that tiny, how are individual traders extracting substantial profits from the market? To understand how money is made, we first have to look at how these movements are measured. Traders do not track dollars and cents. They track something called a pip, which stands for percentage in point. Take a look at this exchange rate. If the euro to US dollar ratio moves from 1.1000 to 1.1001, that shift in the fourth decimal place is exactly one single pip. Because these fractions of a penny dictate everything, traditional line charts do not offer enough detail. Instead, traders rely on a specific visual tool called a candlestick chart to track the price action over time. This central body shows where the price opened and closed. A green bullish body indicates a rise. A red bearish body marks a drop. The thin wicks map the absolute high and low points the price reached, showing where the market faced rejection. Collectively, these shapes form a precise historical transcript of the psychological battle between buyers and sellers. Understanding pips is only the first step. Because a single pip represents such a tiny fraction of a cent, you have to trade currency in massive bulk to see any real return. In Forex, this bulk order is called a lot. A single standard lot represents 100,000 units of currency. Obviously, the average retail trader does not have $100,000 in liquid capital to drop on every trade. That capital barrier is crossed using a financial mechanism called leverage. Leverage acts as a multiplier. Your broker lets you use a small amount of your own capital, say $1,000, and applies a 1-to-100 multiplier. Suddenly, your small deposit controls a $100,000 position in the market. The broker provides this buying power, but they do not do it for free. Instead of charging a direct fee, they take their cut through the spread, the slight gap between the price you can buy a currency for and the price you can sell it for. With leverage applied, the math changes. A microscopic shift of a few pips is amplified, turning fraction of a cent movements into actual capital growth. However, that amplifier works in both directions. The exact same multiplier that accelerates your profit will equally accelerate your losses. If a highly leveraged trade moves against you, you run into what is known as a margin call. This is the moment your broker forcefully closes your losing position and wipes out your account balance to protect their own capital. This is the dividing line between amateurs and professionals. A gambler enters this market relying on luck and emotion. A professional trader relies entirely on structure and rigorous mathematical discipline. To survive, professionals follow a strict rule: never risk more than 1% of their total balance on any single trade. They enforce this using a stop-loss order, an automatic emergency brake. If price hits that barrier, the system cuts the trade, keeping the rest safe. Long-term profitability does not require you to predict the future with perfect accuracy. It requires managing your exposure so that inevitable small losses are eclipsed by larger, calculated wins. Forex trading is a highly disciplined skill of interpreting price action and managing mathematical probabilities. If you want to master it, open a demo account and practice those probabilities before ever risking real capital.